Imagine waking up tomorrow to find the entire global financial system in cardiac arrest. The unthinkable has happened. The world's largest pile of debt, a $10 trillion mountain built over 3 decades, has just begun to collapse. And it's not happening on Wall Street. It's not happening in Washington. It's happening in Tokyo. For years, Japan's central bank played God with its bond market, creating a bizarre trillion-dollar experiment that twisted the very rules of economics. They printed money, bought their own government's debt, and kept interest rates below zero, creating a financial fantasy land. But that fantasy has just ended. The experiment has exploded, and the shockwave now rippling across oceans will do one thing with absolute certainty: send the price of gold and silver into the stratosphere. Welcome to Bullion Signal, and welcome to the most critical financial story of our lifetime. If you've ever worried about the value of your savings, your pension, or your investments, you cannot look away from what's unfolding right now. Before this video ends, you'll understand exactly why this distant crisis is about to hit your wallet, and why physical gold and silver are about to become the most important assets you can hold. So, if you're ready for the truth, stick with me. And if you're new here, do us a huge favor, hit that like button and subscribe to Bullion Signal. We cut through the noise to bring you signals that matter for your wealth. And trust me, this is the biggest signal we've ever seen. For decades, Japan was the quiet, polite giant of global finance. While America partied on subprime mortgages and Europe wrestled with the euro, Japan was conducting a radical economic experiment in plain sight. Their problem was simple but massive: crushing deflation. Prices kept falling, people hoarded cash instead of spending it, and growth vanished. So the Bank of Japan decided to fight fire with a financial flamethrower. They launched something called quantitative and qualitative easing, or QQE. Sounds complex, but the idea was simple. They would create yen out of thin air and use it to buy Japanese government bonds, or JGBs, lots of them. Imagine the Federal Reserve printing dollars to buy US Treasuries, but on steroids, and for years on end. They didn't just dip their toes in, they became the market. At one point, the Bank of Japan was buying more bonds than the government itself was issuing. They swallowed up so much debt that they now own over half of the entire Japanese government bond market. They pushed their main interest rate into negative territory, meaning they charged banks to hold reserves, hoping to force lending. This created a surreal world where a government with debt worth over 250% of its national economy could borrow money for 30 years and pay almost nothing in interest. It was the ultimate distortion, a financial wonderland where the rules of gravity, where high debt leads to high interest rates, were suspended. The world watched, some in horror, some in envy. For years, experts called it a doomed pyramid scheme. They warned that Japan was a bug in search of a windshield. But year after year, the experiment held. The yen didn't hyperinflate. The bond market didn't implode. Japan became the poster child for modern monetary theory, the living proof that a major nation could seemingly monetize its debt without immediate consequence. Global investors, starving for yield in a world of zero interest rates, borrowed cheap yen in what OS called the carry trade, and poured that money into higher-yielding assets everywhere, from US tech stocks to Brazilian real estate. The entire global financial system became hooked on this Japanese fantasy, on this endless fountain of cheap, reliable yen. The stability of Japan's bond market became a cornerstone of global finance. But here at Bullion Signal, we've always said that no market can defy true economics forever. Artificial pressure, no matter how great, must eventually be released. And in late 2022, the first cracks began to show. As inflation finally reared its head globally, the Bank of Japan found itself in an impossible trap. To defend the crashing value of the yen, they had to let interest rates rise, but to let rates rise would blow up their own bond market, destroying the very experiment they had built. For months, they fought a losing battle, spending hundreds of billions of their foreign reserves to prop up the yen while still trying to cap bond yields. It was a financial war on two fronts, and they were running out of ammunition. Then, the dam broke. In December of 2023, the Bank of Japan made a small, almost technical tweak. They allowed the yield on the 10-year Japanese government bond to rise slightly above their long-held ceiling. It was a mere 0.25% shift, but in the context of this controlled experiment, it was a detonation. The market understood instantly. The era of total control was over. The central bank was blinking. The defender was retreating. The immediate reaction was a violent tremor. The yen jerked wildly. Global bond markets, from US Treasuries to German bunds, sold off in unison. Why? Because if the last bastion of zero interest rates falls, then the entire global interest rate structure must be repriced higher. But this was just the tremor. The real earthquake is what happens next. The Bank of Japan is now trapped. Inflation in Japan is now consistently above their target. The yen is chronically weak, making their energy and food imports crushingly expensive. They must normalize policy to fight inflation and support their currency. But to do so, they must let the yield on their $10 trillion bond mountain go where the market demands. And when the market prices the debt of a country with a 250% debt to GDP ratio, it won't be kind. We are talking about a potential runaway spike in yields. Now, this isn't just a Japanese problem. This is a global systemic risk. Japan is the world's largest creditor nation. Japanese institutions, like pension funds and insurance companies, own trillions of dollars in foreign assets. U.S. bonds, European stocks, you name it. As yields rise at home, these institutions face massive, unsustainable losses on their domestic bond portfolios. To stay solvent, to meet obligations, they will be forced to do one thing: sell their foreign holdings and bring the money back to Japan. This is the great global liquidity drain that few are talking about. Imagine a tidal wave of capital, not flowing out into the world seeking returns, but rushing back to Tokyo to plug a hole. This reverse flow will suck liquidity out of every major market on the planet, just when those markets are already fragile from aggressive rate hikes in the West. The result will be a violent, synchronized sell-off in bonds and stocks worldwide, a liquidity crisis, a margin call on the entire globe. And in that exact moment of panic, when trust in central banks evaporates and paper assets tumble, history tells us exactly where the smart money will run for cover. But we'll get to that in just a moment. First, if you're understanding the enormity of this, do me a favor. Take a second to hit that like button. It helps the YouTube algorithm recommend this crucial information to other smart viewers like you. And subscribe to Bullion Signal with notifications on, because part 2 of this story is where we connect the dots to your portfolio and the explosive move in precious metals that is now locked in. Reserve's own attempts to control inflation. They sell Apple, they sell Microsoft, they sell German bonds. This mass selling creates a vortex. Falling bond prices mean higher yields globally, which makes borrowing costs unbearable for governments and corporations already drowning in debt. Falling stock prices evaporate wealth, triggering margin calls and more forced selling. This is the dreaded contagion. It's not just a Japanese problem anymore, it's a worldwide liquidity heart attack. And standing in the middle of it, holding the defibrillator paddles, is the Federal Reserve. But here's the cruel twist. Their hands are tied. The Fed is already battling its own inflation monster, created by years of its own money printing. To fight inflation, they must keep rates high and reduce their balance sheet, a process called quantitative tightening, or QT. They are actively pulling liquidity out of the system. But now, as the Japanese fire sale hits, creating a violent dollar shortage and crashing asset prices, the world will scream for the Fed to stop. They'll demand a pivot, a return to printing money and cutting rates to provide emergency liquidity and save the markets. Can you see the impossible paradox? The Fed must choose between fighting inflation and fighting a financial collapse. It cannot do both. And this, friends of Bullion Signal, is the precise catalyst for the historic surge in gold and silver. Let's break down why this chaos is rocket fuel for precious metals. First, consider the currency storm that's coming. The Japanese yen has been the funding currency for the world's carry trade for a generation. Investors borrowed cheap yen to invest in higher yielding assets everywhere. Now, as the Bank of Japan is forced to raise rates, that trade unwinds. Everyone who borrowed yen must now buy it back to repay their loans. This causes a sharp, potentially violent rally in the yen's value. But at the same time, a global flight to safety also traditionally boosts the US dollar. So what do we get? A chaotic, unpredictable war between the yen and the dollar, with the euro and other currencies caught in the crossfire. When the world's 2 most important fiat currencies are in a volatile, destabilizing tug of war, what loses its confidence? The entire fiat system. People and institutions look at this chaos and ask a simple question: which of these pieces of paper do I trust? The answer, increasingly, is none of them. This loss of faith in all fiat currencies is the ultimate bedrock for gold and silver. They are not someone else's liability. They are not created by a central bank's keyboard. They are neutral, timeless money. In a currency war, the only ceasefire is held in physical metal. Second, look at the bond market. For decades, government bonds were considered risk-free assets, the safe haven in a storm. That myth is now dead. Japanese bonds are blowing up. UK bonds famously crashed in 2022. US long-dated treasuries have been in a bear market for years. When both stocks and bonds are falling together, a phenomenon called correlation breakdown that we've seen flashes of recently, where does the traditional 60-40 portfolio hide? It has nowhere to go. This complete failure of the traditional diversification playbook will force a monumental shift in institutional asset allocation. Pension funds, endowments, and sovereign wealth funds will be mandated to find a real safe haven, a non-correlated asset. That asset is physical gold, and to a more volatile but potentially more rewarding degree, physical silver. We are talking about the possibility of trillions of dollars in institutional capital making even a small allocation shift, say 1% to 5%, into the precious metals market. The problem? The physical market is tiny. All the gold ever mined is worth about 12 trillion. All the investable silver above ground is worth a fraction of that. A tidal wave of institutional demand hitting a small, finite pool of physical metal can only have one result: parabolic price discovery. Third, consider the response function. When this liquidity crisis hits its peak and the financial system seizes up, what will central banks do? History is our guide. In 2008, they printed. In 2020, they printed even more. In the coming crisis, which will be an order of magnitude larger due to the sheer scale of global debt, they will have no choice but to launch quantitative easing to the stars. They will monetize everything. They will buy corporate bonds. They will buy stocks. They will directly fund governments. This will be the final blatant merger of monetary and fiscal policy. It will be called saving the system, but it will be the definitive devaluation of currency. Inflation will not be transitory. It will become structurally embedded. In that environment, you do not want to hold the liability that is being devalued. You want to hold the asset that they cannot print. Gold has been the ultimate store of value for 5,000 years, precisely because it cannot be created by decree. It stands as the judge of monetary folly. And silver? Silver is gold's high-octane sibling. It has all the monetary history of gold, but it sits at the heart of the modern industrial economy in solar panels, electric vehicles, electronics, and defense tech. A supply crunch is already looming due to insane industrial demand. Add a tsunami of monetary investment demand on top of that, and you have a powder keg waiting for a spark. The coming liquidity crisis is that spark. But here's what most mainstream commentators miss. This isn't just a trade. This is a fundamental regime change. We are moving from a 40-year era of falling interest rates and trusting central banks to an era of rising rates, failing control, and broken trust. In such a transition, wealth doesn't just move from one stock to another. It moves from one system to another. It moves out of financial assets and into tangible hold-in-your-hand assets. It moves out of promises and into things. This is the great reallocation. And for us, here at Bullion Signal, this is the signal we've been waiting for. This is not about timing a quick 10% pop. This is about recognizing a historic, multi-year wealth preservation event. The numbers will become staggering, but don't get lost in the digits. Focus on the narrative. Your paper wealth is being systemically redirected into real wealth. Before we go into exactly what this means for you and the practical steps you should consider, I need you to do something. If this analysis is making sense, if you see the storm clouds gathering, you need to be part of this conversation. The comment section below is where the smart money shares insights. Tell me, are you seeing the cracks in the system? What steps are you taking? Share your thoughts, because this is a community that sees through the illusion. And if you haven't already, smash that like button. It tells YouTube this is critical information that needs to reach everyone preparing their finances. Now, let's get into what happens when this monetary reset reaches your doorstep. So the Fed is trapped. To save the system from a liquidity collapse triggered by Japan's bond market unraveling, they would have to abruptly reverse course, cut rates, and restart quantitative easing, flooding the world with yet more dollars. But to do that would be to surrender completely in their war on inflation, guaranteeing that the inflationary genie is never forced back into the bottle. This is the impossible choice. Allow a deflationary financial crash or trigger a final hyperinflationary currency crisis. In reality, they will likely choose a disastrous middle path, reacting too slowly as markets break, then printing too much in a panic. This volatile seesaw between liquidity fear and inflation terror is the perfect storm. It creates an environment where both bonds and cash become toxic. Bonds lose value as fear of default and monetization rises. Cash loses purchasing power as the printing presses ultimately ramp up. This is the critical juncture where wealth doesn't rotate. It evacuates. It flees the world of financial promises and seeks the world of tangible reality. This is the precise moment gold and silver cease being mere commodities and reassert their historical role as the only forms of money that are not simultaneously someone else as liability. For us at Bullion Signal, this isn't speculation. It's observing a predictable human and institutional pattern at a planetary scale. The initial surge in metals will not be a straight line. It will be a violent, chaotic updraft within a collapsing financial hurricane. As Japanese institutions and other forced sellers liquidate everything, they will also sell paper gold derivatives, ETFs, and futures contracts to raise dollar liquidity. This could create a sharp, counterintuitive smash in the quoted paper price of gold and silver, even as physical demand from aware buyers in the East and among central banks soars. This divergence is the signal. It will expose the fatal flaw in the paper precious metal system, the gigantic 100-to-1 leverage of paper claims to physical metal. When the demand for physical delivery hits this over-leveraged structure, the price discovery mechanism will break. The quoted price on your screen will become almost meaningless, a ghost image of a dead system. The real price will be what a willing buyer pays a willing seller for a real bar or coin in a private transaction. This is when the true value, suppressed for decades by this paper derivative scheme, will be unleashed. Think of it as a dam cracking. The paper price is the calm water level behind the wall. The physical market is the immense pressure building up against it. The forced selling from the liquidity crisis is the final quake that fractures the structure. Then, the flood. Who will be the buyers driving this historic revaluation? The cast is already assembling, and it's powerful. First, the central banks themselves, not the West, but the East and the global South. For over a decade, the central banks of Russia, China, India, Turkey, Poland, Singapore, and many others have been net buyers of gold, repatriating their holdings from New York and London vaults. They are doing this silently, systematically. Why? Because they see the end of the dollar-dominated monetary order. They are preparing for a system where global trade is settled, at least in part, in a neutral, non-political asset. They are converting their paper dollar reserves into indestructible sovereign wealth. Their buying is a slow, persistent pressure on the physical market, already soaking up annual mine supply. When the crisis hits, their buying will not stop. It will accelerate as they seek to protect their nations from the currency chaos. The second group of buyers is the informed public, globally. This includes the viewers of Bullion Signal and millions like them who have quietly been exchanging their fiat currency for hard assets. This is the smart money on Main Street, from doctors and engineers in Germany buying gold bars to farmers in the Midwest stacking silver rounds. They may not move billions at once, but their collective demand is a vast, determined, and growing force. They don't use margin, they take delivery. They are the bedrock of the physical market. The third and most volatile buyer will be the panicked institutional money. This is the trillion-dollar pension funds, insurance companies, and hedge funds that we discussed. When their traditional 60-40 portfolio fails catastrophically and their risk managers are fired, the mandate will change. The search for a truly non-correlated asset will lead them, belatedly, to gold. But they are too large for the physical market. They will rush into the large liquid ETFs like GLD. This will push the paper price up violently, but it will also strain the mechanism that promises paper can be exchanged for metal. This institutional panic buying into paper proxies will be the final lever that breaks the system's back, exposing the physical shortage in a very public, undeniable way. Now, let's talk about silver specifically, because its story is even more compelling than gold's. Silver is the schizophrenic metal. It is money, and it is the ultimate industrial commodity. On the monetary side, it follows gold, just with more volatility. When gold rises, silver historically rises much more. That's the gold to silver ratio compression. But the industrial side is what makes this cycle unique. We are in the early stages of a global energy transition, a rewiring of the entire world's infrastructure. Silver is irreplaceable. It is the best conductor of heat and electricity on the planet. Every single solar panel needs it, about 20 grams per panel. The Biden administration's goal is to increase USEP solar capacity by 500% in a decade. China, India, Europe all have similar aggressive targets. Then there's 5G and electronics, electric vehicle connectors, military tech, and medicine. The demand is already projected to outstrip supply for years to come. The existing above-ground stockpiles are depleted. Now, layer on top of that an epic monetary investment demand driven by a global loss of faith in currency. The industrial demand creates a firm rising price floor. The monetary demand sends it through the roof. This twin-engine dynamic is why many analysts believe silver's move will be the trade of a generation. It's not just a precious metal, it's a critical strategic resource in a resource-hungry, technologically desperate world that is also experiencing a monetary collapse. The convergence is historic. So, what is the practical path for you? First, shift your mindset. View gold and silver not as an investment that you trade, but as foundational savings, the portion of your wealth you're choosing to preserve permanently outside the banking and financial system. This is wealth insurance. You don't hope your house burns down to collect insurance. You hold it for catastrophic protection. This is the same. Start now, before the panic is front-page news. Acquire physical metal in recognizable liquid forms, government-minted coins or reputable refiner bars. Store them securely, privately, and within your direct control. Second, understand allocation. There is no one-size-fits-all answer, but a starting point for many is to aim for a tangible asset allocation that lets you sleep soundly. For some, that's 5% of their net worth. For others preparing for greater turbulence, it's 20%, 30%, or more. Within that, a common strategy is a core position in gold for stability and a strategic position in silver for potential exponential growth. Third, be patient and disciplined. The paper price will be manipulated and will whipsaw violently, especially in a liquidity crisis. These smashes are not signals of weakness. They are opportunities for those with cash and courage to convert failing currency into more ounces. Ignore the day-to-day noise. Your benchmark is not the dollar price, it's how many ounces you hold. Your wealth is measured in weight, not in digits, subject to a central banker's whim. Finally, recognize this for what it is: a transfer of wealth. It happens in every monetary reset. Wealth is not destroyed. It is transferred from those who hold the failing assets to those who hold the succeeding assets, from those who trusted the system blindly to those who prepared for its failure. This is not about greed. It's about prudence and historical awareness. By taking these steps, you're not betting against your country. You are taking personal responsibility for the security and prosperity of your family in the face of systemic failure. You are opting out of the madness and into sanity. As we conclude this 3-part Bullion Signal special, I have a final request for you. Your understanding is power, but shared understanding is strength. We are building a community of the clear-eyed and the prepared. So take action in 2 ways. First, for yourself. Make a plan this week. Even if it's small, take the first concrete step toward tangible wealth preservation. Second, for your community, share this knowledge. Click the share button right now. Send this video to 2 people you care about, a family member, a close friend. Start that difficult but crucial conversation. The coming years will separate those who were warned from those who were not. Be the warning, and engage with us below. The comment section is our forum. Tell me your thoughts, your questions, your plans. Are you moving into physical metals? What's your biggest concern? Let's discuss. Your interaction tells the algorithm this is vital, life-changing information, pushing it to others who need it. If you found this journey through the collapse of Japan's experiment and its global ramifications valuable, please like this video, and if you haven't already, subscribe to Bullion Signal and ring the bell. We are here to provide the signals you need to navigate this historic transition. Thank you for watching, for trusting your own judgment, and for being part of our community. Stay strong, stay prepared, and we'll see you in the next video.